Banks are running out of cash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, banks are getting increasingly desperate for cash, and this is forcing the Fed to reevaluate its emergency lending program to consider, get this, making even more cash available to the banks. And this is simply because the giant liquidity vortex that's opened up in the middle of the banking system, there is no amount of money that seems to plug this, and yet the Fed continues to believe that it's just a matter of getting to the right number and the problem will go away. I'm going to show you which bank is on the forefront of this cash need and why there's no amount of money the Fed could pour into the system that could stop this from happening. Plus, we're hearing from a Fed official who seemingly is confused and says that he's not sure if all these banking stresses will lead to a contraction in credit. Well, we're going to show you that not only will it lead to a contraction in credit, that it already is. Plus, on top of that, we're getting news out of Asia right now that's showing the deflationary crisis is actually getting deeper. Let's over to Bloomberg, where we picked today's story up with a headline: U.S. mulls more support for the banks while giving First Republic time. Now, this is interesting because, we had this belief that going into the solution by the Fed and all these other policymakers, that this would be what we need to solve the problem. And yet, as I suggested in the weeks before, as we went through this, this was merely a Band-Aid on a much larger problem, and that it actually wouldn't work. And now we're seeing First Republic, the first bank now to come back, almost, not yet, very close to saying, hey, you know what? We need more money, and I'm going to show you why. They're actually probably going to. First Republic stock has plunged more than 90% this month amid concerns that the San Francisco-based lender could fall victim to the same forces that recently caused a trio of U.S. banks to collapse. And of course, the reason we're seeing these stocks continue to fall is because investors have figured out that if there is a bailout, it's not going to be the shareholders, and it's not going to be the bondholders, and any signs of stress, and they're going to sell. But while those banks topple when rapid customer withdrawals force them to lock in losses on depreciated assets, First Republic has remained open and independent, well, at least for now. Because behind the scenes, they have concluded the bank's deposits are stabilizing. At least that's the hope, because, we talked about that there would likely be a calm in the middle of the storm here where deposits would finally kind of balance out. We're seeing that now, but I can suggest to you that the first sign of any further stress anywhere in the banking system, you're going to see more money run really fast out of these banks. And that isn't susceptible to the kind of sudden severe run that prompted regulators to seize Silicon Valley Bank within just a few days. Although First Republic has structural problems with its balance sheet, it has cash, at least for now, to meet client needs while explore solutions, one of which includes a sale. That includes, on top of all this cash that is received from the Fed and other agencies, $30 billion deposited by the nation's largest banks this month. And so here you have an issue where seemingly tens and billions of dollars have been poured into this bank overnight for almost what we would consider no reason why. I mean, when we looked at the bank before, everything would say, hey, everything's fine. And then literally out of nowhere, this giant hole in the banking system opens up. Liquidity just gets sucked into it. And now you see tens of billions of dollars being thrown at it. And yet, what are we starting to see? That, well, perhaps deposits are stabilizing as they try to figure things out. But the problem here is all of this money isn't fixing the problem. The hole is still there, and it's probably going to get a whole lot worse. A potential adjustment to the Federal Reserve's emergency lending program announced on March 13 is among the options available authorities have weighed in recent days because they don't have any other options. And this is what we kind of talked about in that emergency meeting that Janet Yellen held on Friday. Remember, the Treasury Secretary, she called this meeting, and what did I say? That they would not have a solution. And right now, the only answer they've got is, well, just open up your lines of lending program a little bit bigger, Fed, and maybe that will fix the hole, because the problem happened to be is maybe you just didn't offer enough money to be lent to these small and mid-sized banks. And again, as I suggested, that isn't going to fix the problem at all. Any expansion in the Fed's liquidity offerings would apply to all eligible users, as in standing with the rules, keeping with banking law that says remedies must be broadly based rather than aimed at helping a particular bank, but the change can be made in a way to ensure that First Republic benefits. Well, of course, because if they're on the leading edge of banks who say, hey, we're running out of cash, we don't have any other options because, we've kind of explored them and, well, we haven't really gotten any answers, the Fed could easily step in and say, hey, you know what? We'll just make the amount of money you can borrow from us a little bit more. And yes, we're going to do it specifically for First Republic, but yet the Fed won't say that. They'll just say broad-based they feel that there's some more need for some more money to be available just in case other banks need it. And of course, we know First Republic will be the number one bank in line for this. And it's not as if we couldn't see this problem forming, because the Fed is literally sitting on this problem or the solution, as we've talked about in prior shows. Here you can see $2.2 trillion in overnight reverse repurchase agreements. If you can imagine if the Fed would get out of this business of backing these money market accounts, look at this, their offering rate from the Fed, 4.8%. Do you know what banks like First Republic cannot compete with? Rates at 4.8%. They have no ability to. So at some point, you're going to see additional stresses in the system likely to form. And what will happen is more money will run over to the Fed, who is just seemingly clueless that they actually could be part of the solution by dropping that rate to zero, maybe even negative, and pushing that 2.2 trillion back out in the banking system, some of which I could assure you will find its way to First Republic. But if we're looking for this gaping hole in the monetary system that's coming down to the banking system, we'll see this in the M2. Now we should get an update here either tomorrow or Wednesday for February, and we can see on a year-over-year rate of change it's running negative, and this is not unusual when you have a massive expansion in debt and then a huge contraction in credit and money that has to go to that debt and inside the economy. And now we're seeing this M2 go negative. Now historically it's very rare, but what it tells us is money is going away, because this is what happens when you have a massive amount of debt and of course not enough money to cover it, which is natural to our system. But in this case, we have a whole lot more debt from the pandemic and we didn't actually create enough money to service it all. And so now we're seeing the money supply contract. This is impacting the banks who are desperate for cash. And yet again, the Fed sitting on 2.2 trillion of it right now. But to show you just how clueless these policymakers are, well, let's head over to the Minneapolis Fed. Well, we get this headline from Bloomberg as Fed's Kashkari says banks drained bring risk of recession closer, which actually shouldn't be a surprise, because as many of you know, if you were around during the savings and loan crisis, that these problems in the banks tend to lead to a recession. From the simple standpoint is, if banks aren't lending, new money isn't created in the economy, and that means the existing money has to go to service the debt, and all of a sudden you start to see a slowdown, or in the case we're seeing today, a contraction in the money supply, and next thing you know, things start to break in the system, and all of a sudden, what have we seen in small, mid-sized banks? Exactly that. But let's look at how clueless this guy is. What's unclear for us is how much of these banking stresses are leading to a widespread credit crunch. Well, and the reality is, if you think about it, how many consumers are going to want to go to First Republic and say, hey, we hear you've got some problems and I'd like to borrow some money from you? Yeah, probably not something a lot of consumers would think about doing, or even businesses. They might start looking elsewhere, but you start to look at some of these banks that are under stress and they don't have the ability to lend because they're now looking at so much money flowing out that there's just isn't the capacity to go out and borrow against deposits that you have a reason to believe are going to be leaving in the near future. Is this something that we're monitoring very, very closely? Neil says, a voter on monetary policy this year. It's too soon to make any forecast about the next interest rate meeting, which of course we wouldn't expect them to. But Neil, I want you to see this chart here if you happen to be watching, or maybe one of your staffers. This from the St. Louis Fed, one of your neighbors to the south, because Neil's up there in Minneapolis Fed. And here we see the net percentage of domestic banks tightening for commercial and industrial loans shown in blue, and against commercial commercial and industrial loans at all commercial banks on a year-over-year rate of change, because I want you to see that he noted that he's not sure if this would lead to a contraction or tightening of credit. And the answer is it absolutely does each and every time. When the banks tighten lending standards, of course, they originate fewer loans and credit starts to dry up. Here we can see that anywhere over the black horizontal line, as the blue line goes higher, it means that banks are tightening lending standards. And lo and behold, what you see, the year-over-year rate of change in commercial industrial loans at all commercial banks slows down, crosses that black line, and goes negative. You can see it each and every time the banks start to tighten lending standards. And so what we're seeing right now is lending standards are tight, credit is starting to slow down, which is exactly what he happens to be unsure about. Now, Kashkari noted that a pullback in bank lending amid the sector's turmoil right now may help provide some tightening that policymakers hope will bring down inflation, potentially leading to fewer interest rate increases being required. And that is absolutely true, because if you think about what inflation actually is, it's the expansion, of course, of the money supply. You think about money moving through the system, money being created by the system, and so you have all this money being created, getting flooded out into the economy, and it leads to inflation. But of course, we know from the pandemic we had supply chain inflation. So when we see credit start to slow down and eventually likely to contract based on what we see throughout history when the banks tighten lending standards, what it tells us is the credit conditions, the banks themselves are actually going to broadly tighten financial conditions. And in case of the answer to Kashkari, Neil, you got that one spot on. And here we can see against the consumer price index, we'll take again the net percentage of commercial industrial loans in terms of tightening standards by the commercial banks. What do we note? As the banks tighten lending standards, here again, now we see the consumer price index in red on a year-over-year rate of change. What do we see it do? It plateaus, rolls over, and goes negative. Here it kind of peaks due to oil and then comes crashing down and goes into deflation. Here we see deflation again. We sort of see this each and every time, and it makes a lot of sense. You think about it from the consumer or even the business perspective. If you want to go out and buy a new car and you go to your bank and they say, hey, it's going to either cost a lot in terms of your interest costs, but standards for you to qualify for that loan are really, really high to the point where maybe you don't qualify. So what happens? You don't buy the car, consumption goes down. And this is exactly what we see the banking system doing right now, is tightening standards at a time when the Fed is under the perception that they're the ones in control. But really, my friends, it's the banks. And that's what Neil is missing. While the banking system is sound, he claimed, I'll let you be the judge of that. As I see in the comments, most of you don't believe it to begin with, and banks have strong capital positions. And if they did, why would First Republic be running out of money and a lot of liquidity? It's going to take time for the current problems to fully work themselves out. Of course, the risk here isn't that they're going to work themselves out, is that this liquidity vortex is going to get bigger and bigger. And in turn, what we're going to see is fewer banks come out of this. Now, many people said that the big mega banks wanted to buy up these small and mid-sized banks. I said, no, that's not the case. They really don't want to get into that space because they need the small and mid-sized banks to do what they do best, and that is originate loans. And here we're seeing evidence of that. First Citizens today to buy Silicon Valley Bank after the biggest bank failure since 2008. But let's see what the story is underneath this, because now First Citizens is one of the top biggest 15 banks in the U.S., and they're buying $72 billion of Silicon Valley's assets at a discount of $16.5 billion. Talk about a great deal. But look at what this leaves behind. $90 billion in securities and other Silicon Valley assets in the hands of the FDIC. Here you see bailout Citi as an estimated cost of the failure to the FDIC of about $20 billion. So we're going to see, the FDIC now apparently get dumped on these upside down assets. Obviously, they'll be forced to sit on it. Who knows? Maybe the Fed. I'd love to hear what you think about this. Weigh in your comments. Do you think the Fed bails out the FDIC? Are we seeing the beginning of that right now? Because we may just be actually seeing that. Now, let's head over to Asia, where we see signs of more deflation. China industrial profits drop on weak demand, falling prices. The plunge in profits came despite data earlier this month showing industrial output rebounded in the first 2 months of the year to 2.4% after the COVID restrictions were scrapped as a wave of infections subsided. Here we see producer deflation, though, deepened, didn't get better. It got worse in February as commodity costs softened, a sign that some factories are cutting prices, resulting in falling revenue and smaller profits, and firms were not able to pass on these higher costs downstream as user demand has not fully recovered. So you think about this again from the banking perspective. They've lent out a whole lot of money to all kinds of businesses. If we're seeing this in China, we're going to see it in the US. That means lower profits, and that means less money to pay on these loans, and perhaps put us next situation for the banks is to see a wave of delinquencies begin as the economy further slows. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.